Good evening and welcome to yet another interesting session on the Indian markets. And we have this evening with us a master of the trade. So please join me in welcoming Prashant Jain, founder and CEO of 3P Investments. Prashant sir, good afternoon and welcome to this session. So you're on mute, Prashant.
Good afternoon, Saibal, and thank you for inviting me to this lovely session. And I wish a very good evening, good afternoon to all your customers as well.
Thank you for joining in, Prashant. And like always, I think the first question that we ask you, and we were meeting earlier this afternoon as well, is about what has happened in the investment world in the last less than 12 months, let's say. I think so many things globally, even in India, politics, policy, and deep uncertainty. So let's start with that, Prashant. What really has been happening? What are your initial reactions to all that has been happening here?
So, India has been an oasis of calm in this very turbulent world. I am sure you will agree with that. That
Absolutely. Yeah.
whichever way you look at it, we seem to be doing quite well. In fact, India's macros are probably the strongest ever. Our current account deficit, which has been our weakness for decades, we were perpetually short on dollars, you know that. So the current account deficit is behaving extremely well. Current account deficit is running under 1%. And the rapid expansion in export of services through GCCs post COVID, through remote working, has been a key contributor of this. And I think this lower current account deficit makes India less vulnerable to any disruption in capital flows or even a spike in oil prices, which used to be our vulnerabilities in the past. Even our fiscal deficit is quite reasonable. Uh, so much so that government has found fiscal space to stimulate. And current year government has given almost 1% of GDP's equivalent as a support to the consumer. RBI also is easing monetary money supply, lowering interest rates. So net, I feel that we are in a very good place, and we should continue to grow above 6% GDP for this year, next year, and hopefully for many years to come.
I mean, one of the obvious questions to this is that obviously there's a lot of confidence on the Indian economy and its long-term growth prospects. But in the short and medium run, do you believe that especially events in US are they going to be a key factor in influencing outcomes in India?
I don't think so. India's strength is its weakness at times like these. We have not done well in goods exports at all. So less than 2% of our GDP is in exports of goods to the US. So the impact will be only to that extent. And on top of that, some of these goods are exempt from tariffs, like pharmaceuticals, like electronics, and like fuels. And even on some of the other categories, like gems and jewelry, the value addition is pretty low. So I think this impact is likely to be minimal on the economy. We should not feel it. Of course, it will impact some families, some people who are employed in garments and polishing of diamonds. But in the overall context of economy, I think the impact will be very small. The risk is that, or the assumption is that service exports will not get taxed. India is a large services exporter to the US. In my opinion, US is unlikely to tax services for two reasons. One, they have a significant surplus on service exports, on services, almost $1 trillion. So you would not want to tax something because then other countries will retaliate, and this is a position of strength for US. So I don't think they are likely to tax that. And second, for every dollar's worth of service that we export through software, through GCC, through BPOs, the US corporations save $3 to $4. So I think it would be self-defeating for them. It would simply be increasing their cost base as well. So I think it is unlikely to be tax services. But should that happen, that impact could be significant, though manageable.
That's an interesting perspective. So fundamentally, service remains the taxation on services policy in the US is going to be an important factor to look forward to in the coming few months. And since we're talking about policy in some manner, I think one of the many one of the things which have cheered up people in India, of course, has been the rationalization of GST. I think. Prior to this, there's been a lot of conversation on how GST has in some manner impeded growth in India, and then this has of course been welcomed by the industry. So give us a bit of perspective on this. What has GST earlier led up to, and then this change, is it really freeing up the economy to consume more? What are the really implications of the GST nationalization?
I mean, I am not clear, so I would not like to say whether GST impeded growth, but yes, you can argue compared to some countries, our tax rates were slightly higher. But government also has a responsibility to manage its fiscal. Net, I think I mean, we were beginning to see some slowdown in consumer space last 1 year or so. The asset quality on some lower quality loans was beginning to deteriorate. That's why RBI was trying to slow down the growth of such loans. So consumer was under some stress. I think the reason for that, to my mind, was that post COVID, digital loans, digital adoption, and EMI based purchases spiked up. And therefore, the household leverage to GDP went up quite sharply. And that was beginning to impact consumption. I think what also happened that some of the traditional categories of consumption, like automobiles, etc., were suffering, to my mind, because they've gone down the priority list of a consumer who is constrained for budget. So let's say electronic goods, mobile phones, the spend on experiences has taken precedence over four-wheelers. It is interesting to note that the smartphone market in India is almost as large as the passenger vehicle market. Both are roughly $40 billion each, roughly. So that tells you how consumer preferences have undergone a change. So automobiles between fiscal 19 to fiscal 25 grew by barely 1.5% a year, which is very weak for a low penetrated category. Only 12% Indian homes have a four-wheeler. So I think, therefore, with this backdrop, government has cut GSTs. It has cut income tax rates at the beginning of the year. Both these put together account for 1% of India's GDP. I think the prime beneficiary of this will not be consumer staples. It will be consumer discretionary. So I feel that since interest rates have also been lowered, cars have become more affordable. The base is weak last few years. So I think this should be one area where growth should improve. Now, the key to this is how long this growth sustains. Will it come back to normal 6 months later, or does it lead to a 2, 3 year growth or cycle?
Interesting. Interesting. That's it. I think the perspective on the smartphone and equivalence between smartphone and consumer and automobiles is very interesting. Very interesting. Prashant, I think you spoke about some of the sectors which are expected to benefit from the both the tax sobs that came in earlier this year and the GST rationalization. But from a government fiscal deficit also you spoke about in some sense. So give us a bit of perspective. Does this policy impact fiscal deficit negatively in some manner? Is the government prepared? What would your sense of that be?
I think the current government has displayed a lot of fiscal prudence and discipline all around. Even in the peak of COVID, our fiscal stimulus was pretty measured. And I think the it has been reiterated by senior officers that government is committed to its fiscal deficit target, I think of 4.4% for the current year, despite this fiscal support. I think there must be some areas where government will either save some money or can target some extra revenue. I think oil prices continue to rule very low, so there could be some scope there to increase taxation, but there could be few more which I am not aware of. But it has been reiterated that fiscal deficit target will be met.
Interesting. That's of course reassuring. We obviously, I think one of the things that we have spoken about a number of times, and I think you yourself have had many times brought this up, has been this entire concern around valuation. And I think are we rightly valued at this point in time? Are we overvalued? Over the last 12, 18 months, this conversation has sort of taken place. And a related issue to that has been, of course, corporate earnings. Are corporate earnings catching up to valuation, or are there challenges to that or not? So I would need your views on both of these elements. One, whether valuations are rationalized, or do you still see some degree of challenge here? And then, of course, how do you see the earning growth sort of moving up from here?
So I will 1 year back we had written in our quarterly that markets were a little ahead of fundamentals. And since then, we have had a 15-month of flat markets time corrections. So because of this, the multiples in India have certainly moderated. And currently, we are trading around 18 times calendar 27 or fiscal 28 earnings. We are at the end of fiscal 26, virtually at the end. So in 6 months' time, I think almost all institutional investors will start thinking fiscal calendar 27 or fiscal 28, based on which multiples look reasonable to me. The current multiples are still 15-20% higher than past Indian averages. But I think we can justify the current higher multiples because the cost of capital in India has fallen both for domestic and for foreign investors. If you look at the dollar premium, annual dollar premium, it is down to 2%. In the past, it used to be 4, 6, 8%. So the gap between Indian and US interest rates, the gap between Indian and US inflation is running around 2%. And that's why you are seeing this 1 year dollar forward premium of 2%. So that, to my mind, makes the cost of capital lower for foreign investors. As far as the local investors are concerned, I think we all know how interest rates have moved lower. Today, you can access home loans at 7.5. You can access car loans at 8.5. 10 years back, your home loans were in double digits. So if inflation falls, if interest rates fall, your cost of capital moves lower. On top of that, what has happened, because the local flows in Indian markets have grown significantly, the volatility which the markets are displaying has come down by 70% in last 20 years. I think in the month of August, foreigners sold almost 35,000 crores worth of stock, but markets, we didn't feel anything. So I think the depth, the size, the sustainability of local flows of capital to equity markets has brought down the volatility sharply, which to my mind should lower also the cost of capital. Now, if you compare India to EMs, 1 year back our premium over EMs was much above long-term averages. But in the last 1 year that we have been flat, EM index is up 20 odd percent, MSCI China is up 50%. So as a result of that, India has significantly underperformed EMs, and our premium over EMs has reverted back to long-term averages. So I feel that valuations are reasonable, and while there is no room for multiples to move up, but I think these multiples can hold on. Now, coming to your second question of earnings growth rates. See, the medium term, longer term estimate of earnings should take into account the lower inflation that we are experiencing. Earnings growth have a close relation to the nominal GDP growth of the country. When your inflation was 9%, your rupee growth of economy was 15%. Today you are averaging 4% inflation. So your rupee growth, nominal growth of economy is around 11 odd percent. Now, earnings cannot diverge too much from that. So I think longer term, my view would be earnings growth in India should be around 11-12%. Now, coming to current year and next year's earnings outlook, I think current year is even below 11%. The earnings growth is quite subdued this year. It should be in high single digits. I think the main reason for that is that current year the RBI has cut interest rates. And nowadays, most bank loans are linked to external benchmarks. So the moment you lower rates, banks have to drop loan rates on existing loans, but deposits take time to reprice. So current year banks profitability, and banks are one third of the index literally. They are a very large part of the profit pool. That growth should be extremely low. NIMs are under pressure. But as we go to next year, deposits will reprice and therefore these margins may see some expansion. So next year looks like a year of, I would say, 15 to 20% earnings growth, and it should be fairly broad based. Autos should grow pretty well. Autos in the current year growth is extremely low because first half was very weak, while second half should be better, but full year is still weak. So next year, I would expect 15 to 20% earnings growth because of the low base of current year. But subsequent to that, I think we should again come back to around 11-12% earnings growth.
I know you spoke about auto in specific, and you also spoke about banks. Any other sectors that you see would revive faster or would show a significantly larger variance in terms of earnings growth over next year, especially Q2 onwards?
So I think Saibal, uh, IT, FMCG, and pharma, these sectors should experience slower growth than average. Banks, life insurance companies,
Mm.
uh, capital spending linked companies, automobiles, these sectors should experience faster growth. Life insurance also, NBFCs, they should experience faster growth. Utilities also should experience below earnings, below average in single digits, but that's the nature of that
Mm.
sector. Yes.
So financial services you see as a key area of growth over next year.
Yes, yes, yes.
Prashant, we'll take you back to the conversation on IT. I know you spoke about how US's policy on soft exports from India could be an important element to look forward to. I think one of the other elements that everybody's discussing is, of course, the impact of AI on jobs in India. And I'll also refer to our conversation earlier this afternoon when we were talking about a relatively lower growth rate in employment by the IT industry. So when you look at these three elements, one of course is US policy, two is overall a bit of a slowdown on IT employment, and then the emergence of AI, of course, especially in what are traditionally called BPO kind of jobs. I think, do you see AI to then become a threat? How do you see IT sort of will counter this? What thoughts around these three elements?
I think, Saibal, the jury is still out on this, and we can argue both ways. So, AI, if companies adopt it in their execution, it should lead to lower headcount for sure. And that is probably what we are experiencing right now. Whether, uh, uh, I mean, whether this impacts margins of companies or not is a separate issue because it depends on how much pricing you pass on and how much costs you save. There is a third issue that if a customer saves money due to lower pricing by vendors due to AI adoption, it does not mean his IT spends are coming down. What you save, you may spend on. Typically, organizations have a bigger wish list than their budget. So, what you save here, you will deploy it elsewhere. So, there are three issues here. The top line growth of these companies, I don't think that should get impacted. But fact remains, this is a very large, slow growing sector. Number two, the margins I don't think should be impacted as much because AI also presents significant opportunities to cut costs. Of course, those who fall behind the curve, they will lose out. But yes, I think headcount addition is now below the top line growth rates. And I think we don't know the exact answer, but even if headcount does not grow in IT services, I don't think it will impact us meaningfully. So, see, India is a country of 140 crores, 1.4 billion people. I think the IT companies employ close to 7 billion people. So, 2-3% of families in India are employed in this industry. So, maybe that number will not grow. Maybe it will degrow by 10% over 3 years, 0.2%. So, it can have some impact, but I don't think it is that will impact the country as a whole. It may impact real estate in Bangalore, but it may have some localized impact. But one more point is that the world is aging. Europe is aging, China is aging, Japan is aging. So I think India is the only large economy which can supply skilled English speaking, technically qualified people, workers to the world. And some will move physically out. So you may export nurses, doctors, farmers, because the way Europe is aging, they may need farmers, the way Japan is aging. And there are some moves afoot on that. And some work will continue to move to India through GCCs. So I think GCCs continue to grow headcount, while IT services may or may not grow. So net, I think it could impact these businesses' growth rates, but I don't think it impacts either IT exports for the country in dollar terms or it impacts the economy as a whole meaningfully.
So it is not alarming, though there are going to be some impacts, of course, when anything of this nature sort of takes place. So moving away from IT a bit, Prashant, we of course you again spoke about a few sectors, but I think one of the questions that I'm seeing on the chat really is around a slightly long-term 10-year growth trend. If you were to look at 10 years of India from here, which industries do you see are really going to be driving that growth? So some of the names that have been mentioned here: infrastructure, cement, steel, government, PSUs, toll companies, defense. Any view on any of this? Defense, of course, has been a quite a headline grabber for some time. But any views on any of these industries, especially in a long-term 10-year kind of a trend?
So I think, see, we need to separate between business growth and stock price growth. So I think when it comes to business growth, consumer discretionary spending, manufacturing, organized retail, e-commerce, quick commerce, airlines, these are sectors that should grow faster than the economy. But we cannot extrapolate these to stock prices because what is very important when you are investing is to try and understand how much of this growth is already priced in. If a stock has moved up 10x, 15x in last 5 years, earnings have not even doubled probably in that company, but stock is up 10x. Why? Because the market seems to be pricing in solid growth over the next 5-10 years. That's why the stock is up 10-15x when profits are barely doubled. So I think uh, and these things can change over 2, 3, 5 years. Something can become expensive, something can become cheap. But if I have to give you my order of preference on sectors, I think one, it would be large caps over small and mid caps. That gap which has opened up in last 5 years, I feel over time it should get bridged. That is one. Two, my overall Nifty compounding target would be 12% a year over 10 years, not more. So expectations have to be reset. You cannot extrapolate the last 5 years. Last 5 year returns were high mainly because of the very low base of markets. In terms of sectors, I think I wouldn't like to guess 10 years because a lot can change. But currently, I think banks, financial services, life insurance companies, automobiles, uh, capital spending, these are sectors I think which should do better. I would have low expectations relatively from IT, from consumer staples, and pharmaceuticals is a very heterogeneous sector, but generally I feel even that may not do as well.
Interesting, Prashant. Since you're talking about sectors, some of the questions that I have got is a request to ask you about your views on the real estate sector.
Well, that is outside my circle of real estate, gold, silver, crypto, you know. But real estate, somehow, I have not invested in. I mean, physical real estate is different, but stocks, somehow, it's a deeply cyclical sector. And when the cycle is at bottom, I have found less risky businesses cheaper. So you buy them, and when the cycle is at the top, you don't feel like buying because there is too much risk. So let me pass that question. Yes.
Interesting. All right. I have another interesting question, and this time it has a reference to Warren Buffett. So I'll read the question in verbatim. It says Warren Buffett has increased his cash holdings to the highest levels in the past recorded history of managing Berkeley. Almost through 28 to 30% of his portfolio has doubled in the past 1 year. How do you look at this investment policy from Berkshire? Is he expecting a significant fall in the US markets in the coming 12 to 18 months?
So I won't know. I mean, the counter to that could be still 70% invested. So, I mean, I won't know, but uh, whether US markets can go experience a sharp fall or not. I mean, if you look by traditional P multiples, CAPE ratios, they appear to be expensive. But if you adjust for the fact that the businesses which are large are generating a lot more free cash flow than what was being generated earlier, because technology businesses, platforms, the free cash flow generation is a lot higher.
Right.
So then these businesses do not appear to be that expensive. But these are very top down views. I am not an expert on US. So, but without trying to answer that, let me give you a different perspective.
Sure.
The In the past, we have experienced that when US markets went into a tailspin, let's say when 9/11 happened or Lehman happened, then Indian markets also fell sharp. But that fall was sharp but brief. And that is because India's profitability of corporates, Nifty EPS, does not depend meaningfully on exports. That is our strength. Our basically we are exporting IT services, and these are not as cyclical as good exports. So India's volatility of economic growth is one of the lowest in the world. Its dependence on outside India is extremely low. So if Indian markets come off because US markets are falling, I would take that as an opportunity and not as a threat. India's external balance sheet, as I mentioned to you, our current account deficit is extremely low, and we are well protected against any disruption in capital flows. I feel going ahead, even if US markets fall, even if FI sells significantly, the extent of fall and the duration of fall will be lower than the past because the flow of local savings to equities is fairly large. It is almost, I would say, uh, 40 or 1,000 crores a month if you include all institutions. That's almost four and a half, $5 billion a month. That's pretty large. And mind you, this is only 10% of our savings on a flow basis. Over next 10 years, I would expect this number to go to 20% or even higher. So I think Indian markets, one can suggest, are probably in a virtuous cycle of delivering lower returns with lower volatility, which should increase or encourage households to up their allocation towards equities, which hopefully should sustain that lower volatility.
Look, very again, very interesting perspective, and but I can't help but ask another question related to the relatively low degree of correlation between U.S. markets and India, or for global markets in India, given India's own economic structure. I think there has been a lot of conversation around de-dollarization, moving away from the dollar as a reserve currency or a currency of trade. How real do you see that to be, and is that something that one should would that be in any manner very beneficial to a country like India?
I don't think so. I don't think so. It would benefit us. What would benefit us is if we achieve a current account surplus and if we have a strong currency. If rupee becomes globally acceptable, that will happen only when you are a strong nation, you are a open country, you play by the rules, and you have current account surplus and you have earned reserves. As of now, we don't. So I think if the share of global trade, of the share of dollar in global trade goes up, goes down, I don't think it impacts India either way.
Okay, interesting. Again, that's an interesting element to bring into the argument. But houses are usually divided on both sides, each sort of representing an idea. To this point on again, India doing well, de-dollarization, U.S. markets, how they will perform. One of the ideas that, of course, has been discussed at length is this idea about global diversification. From a geographical point of view, of course, diversification as part of the asset allocation strategy has been there for long, but I think increasingly there has been interest amongst investors to look at diversifying in global markets. What would your suggestion views be on that?
I think diversification is good, and no one can counter that. And only thing is, it should be thoughtful diversification. So, either you simply go and buy the US or you buy world index, or it can give you diversification for sure, but what the long-term return outcome would be, that would is harder to say. India per se is a very extremely well diversified economy. Its volatility is extremely low. Its macro is strong. So I would say the confidence about India doing well is pretty high. If you want to simply diversify away from the country, from the currency, then you could do it in multiple ways. You could buy simply US Treasury bonds, which are yielding you a respectable interest rates today. You could simply buy gold sitting here. You have diversified from the country, or you buy equities outside India. Now, when you are buying equities outside India, I think some work should be done as to what are the prospects of the underlying companies, growth rates, valuations. And based on that, one can pursue any of these strategies.
So, Prashant, a diversification necessary, but we need to be clear about why we are diversifying, and then obviously what we are diversifying into and to what quantity of your overall portfolio.
So I think Mr. Buffett has said that diversification is humility applied to uncertainty. So we are living in an uncertain world. So you certainly need to diversify, but it should not become diversification. So I think that's why I said if you are buying equities outside India, one needs to do your homework.
Work.
That if you simply want to diversify from the country or currency, a simpler, safer objective, a way to meet that objective would be to just go and buy US treasuries or buy bonds of whichever currency you want. But when you take equities risk, then you need to do proper homework.
Sure. So to our customers who are listening to this call, if you are interested in understanding more about diversification, or like Prashant said, do your homework, your RM could be a good touch point to reach out to. Bringing you back to this eternal question that we keep asking you, Prashant, whenever we meet, which is on this thing about small cap, mid cap, and large cap. You of course spoke earlier saying that large cap, of course, has a much larger chance of this entire gaining from the momentum that's coming in. But a bit of view on the small cap now. I know you spoke about valuation as well, but small cap, how do you see specifically in terms of valuation, also opportunity space? Has that become any better? We know that you have had a view on the fact that that opportunity space is not necessarily rightly priced. So, your views on small cap specifically.
Well, uh, small cap is a very large category. The top 100 are large caps, next 150 are mid caps, and the thousands of other companies are small caps. So when I say something on small caps, it is as a category, but it is such a diverse category that outcomes will be all over the place. Even if small cap index is underperforming massively, there could be 2, 3, 5% of the companies which do exceedingly well, and vice versa. So why I said this is because whatever I say about small cap versus large caps is applicable for these two categories as a whole. In my opinion, the profit growth and the long-term performance of small caps is not superior to large caps. There are two types of small caps, generally speaking. One, which are weaker players in large industries, and the others who are leaders in small industries. I think the second category of small caps is they are good to invest in. But generally, I would avoid the first category of small caps. Now, what has happened in India 5 years back when COVID hit, large caps fell 30%. Let's say 100 became 70. That 100 should have become 200 in 5, 6 years. Instead, 70 has become 200. So, from that point, your returns are 3x instead of 2x. In small caps, 100 became, let's say, 40. It fell 60% in COVID because there was panic. When you don't want to buy large caps, who wants to buy small caps? Now that 40 has become 200. So money is up 5x. There were 3 crore demat accounts pre COVID. Today there are 20 crore demat accounts. So the 17 crore demat accounts that have been added post COVID have no memory, have no experience of markets prior to COVID. The demats did not exist.
Correct.
So 7 out of or 8 out of 10 investors have experienced much higher returns in small caps. And therefore, an opinion has gained ground that small caps create more wealth. I don't think this will hold true for the future. The two will converge. To my mind, next few years, large caps should do better as a category than small caps and mid caps. Also, please observe that IPOs, the supply of stock is almost 4 5 lakh crores a year. And bulk of this supply is in small caps and mid caps. Large caps account for maybe 60% of the market cap of India. But of the flow of supply, maybe they will be 10% or 20% or 30, but it is still much lower than their market cap share. So I think this will also lead to this convergence. I would also be cautious on the narrative driven sectors. So whenever the popular narratives almost always lead to unrealistic expectations, unsustainable valuations. So I think wherever there is a narrative driven investing, whether in small caps or large caps, I would also be cautious around those narratives.
As usual, deep perspective. Thank you for that, Prashant. Prashant, in all of this, if you were to look at India and let's say India's competitive advantage in the global economy, what would these be? And do you think India is really prepared to fully leverage these advantages?
Saibal, more fiction has been written in Excel than Word, right? So
Indeed.
if you look at the Excel spreadsheet of India, we should be the factory of the world also, not just the service center of the world. But for reasons, multiple reasons, we have underperformed our capabilities. You can take almost every box for India today: democracy, rule of law, socio-economic political stability, right? The best demographics among large economies, technically qualified, English speaking, land, labor, sun, water, everything is there in this country. So, but yet we have underperformed in manufacturing. On services, I don't think anyone questions our competitiveness, so I will leave that aside. In manufacturing, the good news is that in sectors where we were not present, where we had no right to win, no scale, no competence, no expertise, sectors like electronics, like EVs, like solar equipment, we seem to be doing well. So India will account for 25% or thereabouts of Apple iPhones assembly with a 20% value addition next year. We have come from zero to that in a short period of time. Solar panels, solar cells, we are scaling up very fast. If you look at locally produced EVs, let's say via Tata Motors or a Mahindra, they are world class, they are quite contemporary, right? So I think I am very optimistic about India's manufacturing as well because we have done well in areas which I had very little hopes on. Of course, there has been a lot of effort from the government, a lot of support, but it means that with some support, some encouragement, some push, our companies can rise to the occasion. In other areas, let's say like mechanical things, ICE vehicles, castings, forgings, machining, metal processing, chemicals, textiles, we have traditional strengths. So, of course, competition is tough, but if we can do well in areas of weakness, I think over time we should be able to do better in the traditional areas also. China is aging, their wages are much higher than India. The world wants to de-risk from its over dependence on China. So I think the global factors, environment is also supportive of India scaling up its manufacturing. So in net, I think India is fairly competitive. And if we do well, the next 10, 20 years, uh, we should do quite well.
And Prashant, a fun question here. So, which sector in India would be able to produce the first real multinational in the coming, let's say, 5 or 10 years?
Tribal India still lacks two things. One, if you look at all the top five, seven economies of the world, US, UK, France, Italy, Germany, Japan, Korea, China, all of them have global brands. All of them. India has virtually no global brands. So it is definitely an area where we need to get our act together. The second is we have not yet innovated in the real sense. There are first movers. We adopt technology, we adopt business models, but genuine innovation in India has been missing. So I think these are two areas where I hope in some Indian companies make progress. Now, which companies can be genuinely multinationals? I think there are in India still our the I think multinationals have far evolved organizational structures, far more decentralized. They have global parameters, processes. So I think in India, most companies tend to be more centralized. You sell all over the world or in many countries, but you are not a true multinational. So I won't want to hazard a guess which sector will lead to that, but I do hope that there are many sectors.
Indeed, we all hope that there are many sectors which produce multinationals. On the discussion around AI, of course, it's a very relatable topic. I think people have a number of views on it. I think one of these on the sidelines of the AI piece, there's all this entire new age conversation around data centers. Of course, people looking at it as an opportunity to invest. That area apparently seems to be also growing given the growth of AI on one side. What's your sense of data centers in India, and do you see again geographically within India some areas benefiting, and hence how does an investor sort of play this out?
I'm afraid I don't understand this well enough to give you a good answer. I mean, all I know of it that this is a extremely low ROCE business. Globally, companies which are there, they make very low return on capital employed. So let me stop there because beyond that, to be honest, I don't know much about this.
Sure, sure. No, appreciate that. Thank you. On AI itself, do you see enough work happening in India to sort of make India a relatively strong force within the realm of AI? We know a lot of work, of course, is happening in the US and China, but do you see India sort of investing adequately in this?
I won't know, Saibal. These are very tough calls to make, but I think we will adopt AI extremely well. And if global enterprises begin to adopt AI, I feel it will be good for service companies out of India because it is hard for me to imagine companies adopting AI without doing a lot of work on their databases or so I think it could provide an opportunity to Indian IT services as and when AI becomes mainstream in large global organizations.
So even to get AI mainstream, you need to have a quality of data, clean up. All of that work would still be a India domain
I think so.
activity.
I think so.
Interesting. Again, an interesting perspective. It's slightly away from the world of investments. If you look at India over the last few couple of years, actually, there have been a number of natural disasters that have hit India, and obviously concern impact on lives, unfortunately, but also on economy, and questions saying, are we really geared up to sort of manage these challenges? Do you see natural disasters in any way becoming a challenge for us? Is there something that one should be concerned about?
See, I think let us not forget the floods and famines of 100 years back also. India has lost millions of people in famines, right? It is all so well documented. So I think we are much better prepared compared to where we were 100 years back. Then, of course, the presence of media was much less. If some landslide happened in some area, you would not even come to know of it. On the other side, I think to the extent we should take care of our environment and especially in the forest areas and in the hills, the mountains, our rivers. These are our real resources. So I think we have to take every step possible so that our development does not erode the strength of ours. But I am hopeful. I am told, I am not sure, that the river Thames was extremely polluted 100 years back. And over time, as you prospered, as you brought in effluent treatment, rules, regulations, it is clean. So I think if you stop discharging untreated effluent today, in 1 month the river will be clean. So I think in there is focus on this. I hope there is greater focus, and I certainly believe it's an area of great concern, and we should certainly preserve and improve our environment. But I don't think these landslides in Himachal, in Sikkim, in floods in many areas, they are of a magnitude which will impact uh, uh, the economy in any meaningful way. Of course, those who are impacted, it is indeed terrible for the news.
I mean, that's a very, very hope-filled thought saying that we must take care of the environment that we're working in. And of course, eventually that's really the resource that that we've inherited, and that's really what is going to give us growth. I think we today this afternoon we've spoken about a range of things, starting from economy to policy making to India, global, obviously talking about environment, finally AI. If I were to request you to summarize this conversation and look at, let's say, three key factors or events which you think investors should look forward to over the next 12 to 18 months, which would these be? And what would your advice really be to long-term investors, Indian investors?
I think, Saibal, the real risks are unknown. If you know something, then it ceases to be a risk. So 9/11 was not known, Lehman, COVID, none. So I really don't know what but some of the obvious ones are this resolution of the US India tariff issue. Uh, So that is one. Two, I would be watchful on US interest rates because the twin deficits in US, they are not experiencing any contraction. And to what extent the world can keep on funding US deficit remains to be seen. If US yields move up meaningfully, I think it would generally be negative for asset classes. India will still do okay because fortunately our flow of dollars is reasonably balanced now. But it could impact stock markets, at least for the near term. Third, we live in an extremely volatile neighborhood. We need to be alert on that. We need to do whatever best we can, strengthen our capabilities. So these are three areas I would be mindful of. Otherwise, I feel India is extremely well placed. We are now growing above 6%. So we are the fastest growing economy in the world. Our banks are in great shape. There are no NPAs. Our corporates are in great shape. Corporate leverage is at a 15-year low. Service exports through remote working continues to grow. We are making good progress in manufacturing. We have socio-economic political stability, which is becoming increasingly rare in many countries of the world. So I would be quite optimistic on India. Only thing is I would suggest is that investor expectations have to be realistic. We should not extrapolate the past returns for two reasons. One, in the past, our inflation was much higher, so it led to higher rupee returns. And two, last 5 years, returns have been very high, primarily because of the very low base the markets fell to in COVID. So I think if you tie in your expectations ballpark to 12% long-term markets compounding, and the longer you hold equities, the more wealth they tend to create. As Mr. Buffett has said, equities are an asset class that transfer wealth from the impatient to the patient. So I think patience has been rewarding in India so far, and I see no reason why it will not reward in the future as well.
John, these words from you are like representative of who you are as a professional, as an investor, and how you look at life and how you look at your investment strategies. Thank you for your time. I think we covered a number of topics, but eventually it comes down to the word patience. If you would really want long-term sustained outcomes, you need to be patient with what we're doing right now. You spoke about how we must stem down our expectation, be reasonable about what you are expecting, whatever has happened in the past may not really happen again. I think both of these are really at the crux of any investment strategy. So thanks a lot, Prashant, for spending time with us. And we will keep looking out to you and taking your advice and guidance as we go forward. Thanks a lot, Prashant, for your time. Appreciate it.
Thank you, Saibal, and thank you all who were there. I thoroughly enjoyed this conversation. Thank you.
Super.
Thank
Thank
you.
you. Good evening, and thank you to all our clients who have logged into this call. Please reach out to our relationship managers. They'll be happy to help you in your investment journey. And good evening.